The world is going through changes. Changes happening at a speed that we have never seen before. This is leading to disruption, chaos, panic, fear, hysteria, and a turbulent economy and marketplace. How do you protect your wealth in a turbulent world? How do you invest for cash flow in alternative assets to escape the rat race in times of uncertainty? How do you decentralize yourself, your family, your community, your business, and your investments to become sovereign and escape the matrix? If you are looking for strategies, tactics, and techniques to escape the rat race and matrix, you are in the right place. My name is MC Lobsher, and this is Cashflow Ninja. This is Cashflow Ninja. I'm MC Lobsher. Thank you so much for joining me for another episode and spending your most valuable resource, your time, once again with me. Everything Cashflow Ninja is at cashflowninja.com. We've got over 1,000 podcasts. We've got 4 books. We've got reports, webinars, and much, much more, all at cashflowninja.com. And don't forget to subscribe to the #1 newsletter in the alternative wealth strategy and the alternative asset investing space, the Wealth Dojo. You can subscribe to the Wealth Dojo by going to cashflowninja.com/subscribe. Joining me today is Jason Smith from the Monolith Group. Jason's going to share a very powerful family office strategy that can be used by business owners to minimize the tax burden on their children and grandchildren. Jason, it's great to see you.
Yeah, thanks for having me.
Yeah, I've been looking forward to our conversation. I think this is a very, very interesting and unique strategy that we're going to share today. So looking forward to dive into that. But before we do, could you please share a little bit about your background and journey?
Absolutely. Yeah, so I'm an entrepreneur at heart. I have been in entrepreneurship really since the age of 8 years old. I started selling greeting cards door to door to raise money, did the lemonade stands and all those sorts of things. So been an entrepreneur, have that spirit within me since my early childhood. And ultimately that led me into some opportunities to develop some tech companies during the dot-com era and pivoted into finance, frankly, because I felt, as most business owners do, for the blood, sweat, and tears I put into those companies, I was questioning, did I leave something on the table? So I pivoted into finance to explore that question. And that's what's ultimately led me into family office opportunities, high net worth planning, and where I am today with the Monolith Group.
So who are some of the people that you and the Monolith Group help? Like what are some of the profiles that you guys work with?
Yeah, we're working with people who have created a significant wealth of 20 million net worth and above, but that doesn't always solve liquidity challenges. So our clients are thinking about a multi-generational approach to the management and the stewardship of their wealth. Developing businesses, that's a rather illiquid wealth. Our clients have large real estate holdings, oil and gas holdings. So the challenge becomes not, are you wealthy? The challenge becomes, do you have the liquidity needed to help move those assets to the next generation? So one of the biggest challenges some of these families face is the estate tax. And so after the lifetime gift exclusion amount is exhausted, they're paying about 40% tax on the assets they're trying to move to the next generation. So that's a significant need for liquidity at the time of death that our program can help address. You also have other issues like buy-sell agreements. Some people are passing away and they have business partners. They need to take care of the estates of their former business partners. And a big topic I'm seeing more and more of is one labeled estate equalization. So mom and dad have built a successful business. They have 3 children. One of those 3 kids happens to be very engaged in the business, has committed to learning the business, helping it grow. And the other 2 kids have found other passions. They're just not interested in what it is that mom and dad built. So when mom and dad eventually pass away or really need to look at some sort of succession plan, how do you consider the contributions of one child to the business, to this asset, but still find some means to provide something to the other two? And so my joke in this space is the four-letter F word in estate planning is fair. How do we make this fair to all three children so that ultimately they still have Thanksgiving dinner together? There's a number of other scenarios where having cash inserted into the estate plan at the time of death really becomes a mechanism to help people take the time to execute on the plan. The estate tax is due within about 9 months of death. A buy-sell agreement, no one wants to be strung along for years on a slow drip payment. So when we insert liquidity into the estate plan, we give people the ability to execute on the vision that the original wealth builders had.
Yeah, it's fascinating to see very successful business owners and their families. I mean, from an asset allocation standpoint, a lot is tied up in the business, and what's not
Yes.
tied up in the business is tied up in real estate, right? Because that
Right.
becomes the second thing. Two asset classes, which I personally love, and everybody on our network
Yep.
personally loves, but very illiquid, both
Yes.
of them. So it provides a massive challenge while they're alive to get liquidity, right, as needed, but especially when they pass away. So it's a massive issue.
And just because you pass away doesn't make it a good time to sell one of those asset classes. I mean,
Right.
here we are in the middle of 2026, but imagine trying to sell an office building 2 years ago. You would take a bath on trying to sell an office building 2 years ago during that interest rate spike and the COVID, sort of the lack of office use through COVID. But you can think about business cycles as well. Construction
Yeah.
businesses. I mean, all businesses have sort of micro cycles they go through, and then macro cycles. And so, just because you pass away doesn't make it a good time for your family to sell the assets that you've spent a lifetime creating and growing.
Yeah. Imagine you had to try and sell a live event planning business, which I know people that have those businesses in 2021,
Right,
2022.
right.
So the revenue just evaporated, and yes, it'll come back, and for most of them it has because they pivoted. But to your point, there's cycles. Um,
Yeah.
let's talk a little bit about the solution, because it's a
Sure.
very unique and interesting strategy
Hmm.
of how you approach to solve this problem.
Yeah, there's two parts to it. At the core, this is a life insurance strategy to create tax-free liquidity that gets inserted into the estate plan upon death. And there's plenty of great information and industry standards on how to organize that. I'm not a CPA or an attorney, and so I don't sort of opine on those aspects of it. But ultimately, there are structures where done properly, a life insurance policy can pay out tax-free into a trust to help address some of these issues without compounding the issue, without adding more liquidity, more assets to the estate from that estate tax perspective. So there's a long history of life insurance being a very useful leverage tool in order to address future needs that are going to happen. Death is certain, with a smaller number of dollars than what you're going to get at the end. So we like the fact that premiums paid in generate a higher benefit somewhere down the road for the clients. The question and the challenge that we seek to solve is, how do you pay for that? So sure, everyone would love to add $20 million to their $50 million portfolio through life insurance, but who wants to write a seven-figure premium check for 12 years? No, not many people. So you can pay for this out of pocket, but you're going to disrupt cash flow. It's going to have an impact on your estate planning because you're going to have to gift those assets likely into a trust to pay the premiums. Or you might even have to sell down some of these assets to be able to afford those premiums. So paying out of pocket is a less complex, very direct way to put this life insurance in place, but it's not without its downsides. The premium finance world offers a solution where you can borrow money from a bank in order to pay those premiums. And now you're on the hook for just the interest on that loan as it accumulates over time. So the premium finance solution is a great step in a direction where we can put large death benefit in place, but mitigate the amount of cash flow that we're disrupting or minimize the amount of assets that have to be sold in order to fund the program. So with those two traditional solutions in place, where the monolith estate planning strategy shines is that we are a 100% debt solution that requires nothing from our clients in a cash perspective. So the monolith group has relationships with a number of banks that will issue a publicly traded bond on behalf of our clients. The greatest advantage to this strategy is we're accessing funds at essentially wholesale rates of interest rather than retail rates of interest like you see with a traditional premium finance structure. So now when we compare the opportunity of zero cash out of pocket and still get this large liquidity in the estate plan, the ultimate question becomes, well, what is the client responsible for? So their responsibility is to post collateral that's going to backstop the issuance of the bond. And so our clients, because they are high net worth, they do have assets they want to continue to leave and grow. What they're giving up is the opportunity cost to leverage those assets for other debt. That's where we're looking at their personal financial statements and determining, you've got these pockets of assets that you intend to never sell. You want to actually leave those to the next generation. If you were willing to put a collateral assignment on this pocket of assets, we could add millions of dollars of life insurance to your estate plan.
This is a very, very unique approach because just to recap, two of the things that you shared is, yes, for a lot of challenges that we shared up front, life insurance is the solution. It's a no-brainer. But now how do you pay for it? And to your point, you could pay for it as you go, but then liquidity, as we just mentioned, is an issue. So now you're putting even more stress on the liquidity, taking money away from the business and away from the family to then pay for it. So that's not very appetizing. Then the second way is, and most of our folks in our world are familiar with premium, the concept of premium financing, where you can go to a bank or perhaps a family office and borrow money to then pay for the life insurance. You can also borrow money from the family itself, which gets into a little bit more complex, not as high level, but there's other ways to do it too. This is very unique because essentially what you do as a family, you have assets that some you might own free and clear, like let's just say a nice portfolio of real estate. And then all of a sudden, instead of paying for it out of pocket or then going to a bank, which is from an underwriting standpoint could be quite a headache, or even more complex estate planning strategies of borrowing the money from have a trust borrow it from yourself kind of thing. You get to issue a family bond secured by this portfolio of real estate, which is owned free and clear, right? And the bond is then issued, and that's how you come up with the money to pay for the life insurance.
That's right. And one slight maybe tweak to that explanation is most of the time what we're seeing is even folks that have these large illiquid assets, they've got their safety net assets. They've got treasuries, they've got a small amount of a portfolio, a brokerage account, et cetera. So that's usually where we look to have the initial collateral assignment, is on something that the bank can very easily get their head around. We are able in some cases to use the real estate itself as the collateral, but what we're trying to do is to make this a very easy process for folks and look at the total picture. So step one for us is there an identifiable need for this program? This isn't something you do just because you can. We want a solid why as to the reason to move forward. So then when we're looking at the personal financial statement of the family, we can then anonymously shop that amongst our banking network and determine which bank is comfortable perhaps with cash flowing industrial real estate, let's say, and is willing to provide a path forward in that sort of real estate.
So the financial obligation to the family is then that you need to pay the interest payments on this bond to the bondholders, correct?
It is. And so in our process, we go out and capitalize not only the premiums we're going to pay, but we also capitalize the projected interest that's going to be paid to the bondholder. So we actually borrow the interest as well as the premiums. And that's what allows the client to have no out-of-pocket expense to their personal cash flow.
Interesting. And then this bond, this quote unquote family bond,
Mm-hmm.
then gets to, through the bank that you're setting it up with, I'm assuming a Wall Street bank, whatever, they shop,
Oh, yeah.
they produce that to their clients as an investment alternative. So someone at a big, insert big, large name bank here,
Yeah,
gets to buy a, Smith or a Lobster family bond.
that's right. And our bonds look like cash on the balance sheets of regulated companies. And what you'll find is that our bonds are typically purchased by mutual funds, insurance companies, anyone that has an overnight cash reserve. And so in this, instance, you come and you want to do this program, XYZ Bank is going to issue the bond on their paper because you don't have a credit rating that's institutional grade, right? And so the bank's institutional grade credit rating allows that bond to be issued at the lowest cost of funds, the 7-day lower floater rate. So now someone like the Janus Fund or USAA is going to purchase that bond, and that's who's going to receive the interest payments. On the other side, once that bond is sold, those proceeds are going into a trust account on your behalf, and we're paying the premiums and the interest out of that trust account on your behalf. And so to kind of fast forward, how does this all wrap up? It's really going to be one of two ways. If the insured passes away, the death benefit is first going to pay back the debt to the bondholder, and then the net death benefit is going to be left for the beneficiaries. The collateral assignment is going to be released, so that way the beneficiaries also inherit whatever that asset is. So the asset stays in the family that was collateralized. That goes to the beneficiaries as well as the net death benefit upon death. There's a second scenario where if someone starts our program young enough where the life insurance policy, we use index universal life policies, where the life insurance policy cash value has the potential to grow large enough that we can do a policy loan. We can pay off the bond, and now we have no other parties involved in the transaction from that point forward.
Like your more traditional premium financing strategy, where eventually there is a policy loan taken against the cash value to pay off the debt.
Right, right. Well, the biggest benefit our strategy has over traditional premium finance is that interest rate. And, with an IUL policy trying to outperform a retail rate of interest, it's a pretty narrow spread. For us, being able to borrow at wholesale rates, we have a more generous spread between what the bond owners are due, plus some of the other costs that are associated with this program. But we still have a more generous spread between the expected performance of an IUL policy based on historical indexes and the costs associated with the program.
Interesting. Can you walk me through an example of for buy sell? Because there's a lot of people in our world that are looking at buy sell agreements, and because if people are listening to this, they can relate. You start a business with your partner. You have no idea where this is going to go.
Right.
And for some, it may or may not work out. Some people, kind of like the business doesn't make it, or it's just one of those things. But for some, while this exceeds expectations by a lot, and now all of a sudden you're into this business 10, 15, 20 years, and you have built quite a business that is now extremely valuable and might be extremely valuable looking in from the outside, right? Even for buyers, private equity, and so forth. So, you now have a different situation that you find yourself in, because at first, when you're just starting or it doesn't really take off, it kind of like stays kind of small, but you get comfortable. A partner passing away or becoming disabled might not be that big of an issue. There's ways to work around it. But you've built now a substantial business together, and now it's a problem. Because if one of you kicked the bucket, there's a massive problem, because there's families that are involved. And I've seen just as you, Jason, we've seen how that works out when there's no planning in place, and it is very ugly. And unfortunately, families that were literally quote unquote family, doing everything together in business together, kids growing up together, all that stuff is torn apart.
Yeah.
So talk me through an example of that, of how this fits into to a buy sell.
Yeah, that's a great perspective, because even folks, whether they were family or not going in, really become closer and more integrated, than they were before the partnership started. And the sad reality is that many times these operating agreements are written and never revisited throughout the process of that growth. So you wake up one day and now you have this significantly valuable asset between the two of you. You look back at what you agreed to, and neither of you can afford to actually execute upon it if something were to happen. So there's that significant liquidity gap, kind of the theme of our solution. Um, what we can come in and do is to help put those life insurance policies in place by leveraging assets of a combination of the business itself and, let's say, the two owners in this scenario. The collateral needs to come from related parties, but it doesn't all have to come from the same party. And so we had a company that creates medical devices, and not to give too much information away on them, but essentially they got picked up by Medicaid, and their profit went from about $600,000 a month to about $13 million per month. So now you have people sitting at the table saying, wow, this is something exciting, but we also have this commitment that we made to each other to take care of one another's families. What we're able to do with the monolith strategy is to come in and say, okay, the business owns the real estate free and clear where you operate. We have an asset in the business. Each of you has been responsible, good stewards, and has saved and invested other funds. You each have brokerage accounts with basic diversified portfolios. We can look at this total wealth picture and find assets that we can collateralize to put life insurance policies on each partner for the benefit of the estate of the other. What we've done now, though, is we have not disrupted cash flow, and we have not done the absolute minimum, which is to say, unfortunately, the response I used to get in my old RIA days was, how much can I get for X amount of premium? Like, well, that's certainly one way to look at this scenario, but the other scenario is if something does happen to one of the partners, the debt that's going to be due would be much larger than what you each decided you wanted to pay in terms of premium. So our solution allows people to look at this from an actual death benefit perspective, and then we can back into the collateral that's needed to solve the true issue, rather than taking the half step, which is, well, we're willing to kick in $50K per year to each get a 20-year term policy, and we'll call that good.
And then collateral, talk to me a little bit about that, what you've seen, what that looks like with buy sell.
It's the same. It's, maybe it's the building that the business operates in, if it's owned free and clear. And then it's, liquidity from each of the individual partners. So it's their brokerage accounts, where they've been responsibly taking dividends out of the business for 5 years or 7 years, and they've accumulated some assets outside of the business that they could also collateralize.
What is the profile of a business owner and their partners that should be looking at something like this and should definitely have a conversation about this?
Yeah, so certainly if the individual families reach that 15 to 20 million net worth and above, so let's say if it's two partners, the business has somewhere of an enterprise value around 40 million plus. And then also, usually if our clients are making about $500,000 per year and above, as a starting point, to really consider this long-term commitment to a solution that's going to be a bit more sophisticated, obviously, than simply paying for it out of pocket, but it's going to allow you to build an asset on top of another asset rather than spending down cash or selling an asset to create this asset.
Yeah, and especially in a buy-sell situation, I mean, you either have to buy out the other partner or spouse if that partner passed away. So there's a number that comes up for that. So then it again, you'll come back to the same situation where well, how do you pay for it?
Yes.
Do you have the liquidity yourself, personal liquidity outside of the business to buy out the other partner or the spouse.
Right.
And for most people, the answer is going to be like, yeah, no, that's not possible.
Well, no.
And then
Yeah.
the second question then becomes, okay, well then what's the other way? Do you have a note that you pay off through I don't
Yeah.
know how many years, and how much liquidity do you have up front? Because you're like, well, if you and I were partners and let's just say I would pass away and my spouse is remaining, and you tell my spouse that, hey, well, I'll pay you 30, 40, 50 years. We'll be all good. It's just going to
Right.
be a little drip. That's also not, and especially that family at that stage really needs liquidity.
Yes.
And then the other solution, which nobody wants to come to, is like, well, we just have to sell this business because
Right.
to pay for it, because we can't afford to keep the business and kind of buy out the other partner or the other spouse. So then you start to look at, okay, well, then obviously clearly there's a solution that's a no-brainer, but then how do you pay for it? And it
Right.
comes back to the earlier discussion of that we had, again, out of pocket, the traditional premium financing route or this route. So it's fascinating that it kind of comes back to the same things in this world, which is this lack of liquidity, whether
Yes.
you're alive and operating or whether you've paused and now there's other liquidity issues.
And there's a great point because like we at the Monolith Group, we really consider ourselves a specialty financing company. And yes, the life insurance is the piece that solves the liquidity issue for the family. But what the Monolith Group does is solves the issue of how to get it in place with the lightest touch possible on the family's ability to continue to grow their net worth.
I think so. Questions. One question that people might have is, you mentioned earlier that you're getting kind of a wholesale rate versus the retail rate. What's kind of the difference between the rates that you've seen but as you mentioned, this wholesale versus retail in your
Sure.
model?
Yeah, our all-in cost is going to be somewhere around 150 basis points less than if you did SOFR plus a traditional bank spread type loan. And
Gotcha.
so that 150 basis points, give or take, is enough of an additional, not true arbitrage, but I'll use that word incorrectly, arbitrage between the interest amount that's being paid out and the projected rate of return on the IUL.
Gotcha.
So if we use like AG 49 numbers, like I'm going to paint with a very broad brush. Uh, let's say we use 6.5% average annual return as the baseline for the IUL. If your interest rate is SOFR plus a bank spread, you're probably, give or take, about at par with that. And so since we conservatively illustrate these policies, we're not trying to tell people you're going to get 8.5% average return in an IUL. If you were trying to justify a retail rate of interest, you might need to do that in some cases for the illustrations to work out. But in our situation, our borrowing rate is going to be about 150 basis points less than retail. So at 6.5% projected return in the IUL, and our borrowing costs historically in the high threes to low fours, we've got a comfortable spread for these policies to perform and ultimately pay off the debt.
Wow. You mentioned something else there. I just wanted to hit on that. SOFR. So a lot of interest rates around the world is based off of LIBOR too. SOFR is just another measure which banks and investment banks and use. So if you're interested in learning more about it, you can go online and you could probably look up the SOFR rate. I mean, that's available there. So I just want to make sure people know that too, because sometimes we have conversations that like, I don't, what was that part? So that's fascinating. That is a really nice spread. I mean, it's yeah. I mean, even on a well-structured whole life policy, you're going to have a spread with that type of a borrowing rate.
Yeah. It's really the key component to allowing the clients for their single responsibility to be posting collateral rather than having to make catch-up interest payments. Like you might have to do what you do have to do with premium finance, traditional premium finance.
One last question for you, Jason. I usually ask people, so what are some of the pitfalls here? Like, how
Oh, yeah.
does a strategy like this go wrong? What are some of the things to look out for when you're executing this?
Yes, the number one aspect is going to be that collateral position. And that's really the crux of the entire transaction from the client's perspective. If if they are going to be uncomfortable posting collateral, knowing that that piece of an asset is not going to be accessible to them for other lending, they're not going to be able to sell it for lifestyle needs, then this transaction is really not going to be the stress-free addition to their personal financial statement that we want it to be. It really comes down to collateral. The other aspect of that is proper management of that collateral. If we're using a bond portfolio, we need that bond portfolio to be managed, that we need that ladder to constantly be updated. We need some other advisor. Since we don't manage money, we need another advisor engaged in ensuring that collateral is properly allocated so that its value maintains some level of consistency. So where these things typically go wrong is either through lifestyle changes or through unfortunate other circumstances. People no longer feel they can or wish to post collateral. And that's the number one warning that we provide people up front, is you're making a long-term commitment to a program that's going to have a significant benefit to your beneficiaries. And for that, your participation requires this collateral assignment.
This has been fascinating. Jason, can you please tell everyone, if they want to explore this or have a conversation, where can they learn more about this? How do they get in touch with you?
Yes, so my email is jason.smith@themonolithgroup.com. That's also our website.
Fantastic. Well, thank you so much for coming on.
Thank
and
you.
having a great conversation and sharing more about this very powerful strategy.
Yeah, thank you.
And thank you to all of my listeners and viewers for again spending your most valuable resource, your time, once again with me on the show. Everything Cashflow Ninja is at cashflowninja.com. That's cashflowninja.com. We've got over 1,000 podcasts, 4 books, webinars, reports, and much, much more, all at cashflowninja.com. And don't forget to subscribe to the #1 newsletter in the alternative wealth strategy and alternative asset space, the Wealth Dojo. You could subscribe to the Wealth Dojo by going to cashflowninja.com/subscribe. Until next time, live infinitely. This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objectives, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness, or completeness.